Without asking your permission, a machine is deciding whether you spend your life working for money or one day watch money work for you. It reaches into your rent, your paycheck, your groceries, and the retirement you are counting on, even if you own no shares. This is not the numbers on the news. It is not gambling, and it is not luck. It is a sorting machine, 2 centuries old, splitting the world into owners and everyone else. You were dropped onto one side at birth, and no one shows you the other. Here is what the machine is, because the picture in your head is almost certainly wrong. A share of stock is not a lottery ticket and not a chip on a table. It is a deed. It is legal ownership of a tiny corner of a real business, the way a single brick could belong to you inside a working bakery, so that every loaf that bakery ever sells owes you a crumb, forever, whether you show up or not. Own enough bricks and you own the bakery. That is all a stock has ever been. A slice of something that earns money while you sleep. Now here is the first thing that should bother you. When you buy that slice on the stock exchange, your money does not go to the company at all. It goes to whoever sold the slice to you, some other investor cashing out. The bakery got its money years earlier, on the single day it first sold those bricks to the public. After that, all the billions racing around the floor of the New York Stock Exchange are ownership changing hands. The same bricks passed from pocket to pocket at prices that never sit still. The market you imagine as a fire hose feeding businesses is mostly a giant title office recording who owns what. And unlike your car or your house, you can buy or sell one of these slices in about the time it takes to send a text. That is the strange gift of the machine. Ownership of a giant company sliced thin enough that anyone can hold a piece and let it go in a heartbeat. It is also the curse, because when millions of people can dump their bricks in a panic on the same afternoon, the price of a rock-solid business can swing like a mood, even when nothing inside the bakery has changed. So when people call the market a casino, they are half right and half dangerously wrong. The frantic daily trading, the green and red arrows. That part is a crowd gambling on feelings, but underneath it sits something no casino has ever had. Real businesses making real things and earning real money that flows to whoever holds the deed. And the price on each brick is stranger than it looks. It is not what the bakery is worth today. It is the crowd's bet on every crumb that bakery will ever pay, stretching decades into the future, all added up and marked down for the risk of waiting. That is why a stock can crash on a sunny day while the ovens are still running. The crowd did not change its mind about today, it changed its mind about tomorrow. Which means the wealth was never sitting in the buying and the selling. So where does it come from, and why does merely holding one of these slices beat almost anything you can do with the paycheck you work so hard for? Think about how your own money behaves. Your wages are water you carry in a bucket. You haul hours to a job. You get paid, and the second you stop hauling, the water stops. That is every job that has ever existed. Income you have to keep showing up for. Ownership is a different animal. It is a well that refills on its own because the business is out there hiring, selling, and raising prices while you sleep or vacation or do nothing at all. Owning a broad slice of American business has historically paid its owners somewhere around 6 to 7 cents on every dollar each year after inflation, and here is the part that matters. Those cents earn their own cents, and those earn more still. A large chunk of the last century's gains came not from prices climbing, but from those little dividend crumbs being fed straight back in to buy more bricks, which then paid out more crumbs. Your salary climbs in a straight line if you were lucky. Ownership bends upward because the returns breed more returns, and a single dollar left alone across a working lifetime has grown into hundreds. Leave that dollar be for long enough and it stops adding and starts multiplying, until a boring sum set aside in your 30s can outgrow decades of the raises you fought so hard to get. And here is the flip side that should sting a little. Sitting out is not staying safe. Every year your money sleeps in a checking account. Inflation shaves a slice off it while the owner's wells keep refilling, so doing nothing is never a neutral choice. It is a slow decision to fall behind. But here is where the story gets sold to you wrong, and the lie costs regular people fortunes. You have heard the market returns about 10% a year, as if it shows up in neat annual slices like a paycheck. It does not. Go back across 93 years of the American market, and the yearly return landed anywhere close to that 10% average in only 6 of them. 6 years out of 93. Every other year, it was rocketing far above or crashing well below, wild swings that only smooth into something calm when you stand back and squint across a lifetime. The 10% is real over decades and a fairy tale in any single year you have to survive. And that gap between the calm average and the ugly reality is where the trap is set. When your slice drops 30% in a bad year, it does not feel like a statistic. It feels like a mistake. Like the smart move is to sell and stop the bleeding. So you hand your slice to someone calmer, usually right before it climbs back. Which raises the real question. If holding on wins, why does nearly everybody lose? And who is standing on the other side of every panic, buying up the slices you are too scared to keep? Here is the part almost nobody understands, and once you see it, you cannot unsee it. You are taught that winning at the market means picking the right companies, like betting on the right horse at the track. It is nothing like that. It is closer to buying a roll of lottery tickets where 4 tickets out of every 100 pay for the entire game, and the other 96 are worthless scraps across their lifetimes. That is not a figure of speech. A finance professor named Hendrik Bessenbinder went back and measured every American stock since 1926, close to 26,000 companies. More than half of them across their entire lives on the market made their owners less money than a boring 1-month government savings bond, the dullest and safest place on earth to park $1. The typical stock, the one sitting in the middle, lost money over its lifetime. And nearly every dollar of real wealth the market has ever produced traces back to the best performing 4% of companies. 86 firms out of thousands created roughly half of all the wealth the entire market made in 90 years. Here is what that does to you. Every hour you spend hunting the next great stock, you are betting against those odds, trying to grab 4 winning tickets out of 100 while 96 burn in your fingers. Even the professionals cannot do it. Over any 15-year stretch, around 9 out of 10 paid fund managers, people with terminals and teams and finance degrees, fail to beat the plain market average. And the reason they fail is not laziness. It is that the rare companies which end up carrying the entire market almost never look like sure things on the way up. The business that towers over the economy today was, decades ago, a risky little bet that plenty of experts laughed at. You cannot reliably spot the 4 winning tickets in advance because at the moment they are printed, they look exactly like the 96 that burn. But the ordinary person who owns a slice of every company at once, the boring index fund sitting in a forgotten account, catches all 4 of those hidden winners without ever learning their names. The market does not pay you for being clever. It pays you for owning everything and refusing to flinch. You are never in a stock-picking game. The game is ownership itself, and the house you have been fighting was never the market. The house is time, and time only works for the people who stay in their seats. If no one has ever laid this out for you before, that is the reason this channel is here. So take a second and subscribe, because the machine only gets stranger from here. So if owning it all and staying put is the winning move, you would expect the rewards to spread around. They do the opposite. The people who understood this early do not merely play the machine. They own the machine, and the rest of us rent our hours to it. According to the Federal Reserve, the wealthiest 10% of American households own about 93% of all the stock in the country. The bottom half of the country, tens of millions of families, hold roughly 1% of it between them. Your retirement account is a teaspoon. The top of the ladder is holding an ocean, and the ocean rises faster than the teaspoon every year that passes. And this is why the gap feels impossible to close. Wages reset with every generation. You start near zero. Your children will start near zero. Each of you selling hours for money from scratch. Ownership does the reverse. It carries across generations, compounding in the background for families who bought their bricks lifetimes ago, so a lucky few inherit a well already gushing, while the rest inherit a bucket and a long shift. The head start is real and measurable. It is the difference between a family that lives on what it owns and one that survives on what it earns, and the two drift further apart with every decade that passes. And here is the twist that should unsettle you because it runs straight through your own money. Over the last 20 years, ordinary people poured their savings into simple index funds, the exact smart, boring move I just described to you. But nearly all of that money flowed through three enormous firms that run those funds, the asset managers whose names sit unread at the bottom of your retirement statement. Those three firms are now the largest single shareholder in roughly 88 out of every 100 of the biggest companies in America. The everyday saver did the right thing, and by doing it, handed a tiny cluster of institutions ownership over almost the entire economy. You funded that concentration with the same paychecks you were trying to protect, which means the system that could finally turn you into an owner is the same system funneling ownership away from you and toward the people who already hold it. And every year you stay outside of it, only earning and never owning, that gap compounds against you using the exact same math that makes it compound for them. There is one more piece, and it explains a feeling you have had in your gut but could never name. You keep hearing the market hit a fresh record in the same week your grocery bill stings and your raise never came. That looks like a contradiction. It is not. The market is a betting line on tomorrow's corporate profits, not a report card on how the country is doing, and certainly not on how you are doing inside it. A company's profit often jumps precisely when its costs drop, and the single biggest cost most companies carry is people. You. That means the same headline that thrills the owners of the machine. A company trimming its staff, holding pay flat, squeezing more output from fewer hands, can be the exact headline that shrinks your paycheck. The stock market and your wages are not on the same team. Half the time they are pulling opposite ends of one rope. And because those prices run on tomorrow's expectations, the market has usually made its move before you ever hear the news. Trying to trade on a headline is like reading last week's weather forecast and stepping outside expecting rain. By the time the story reaches you, the people who own the field already acted on it, and you are betting against their yesterday. Once this clicks, the record highs stop reading like national good news and start looking like what they are, a scoreboard for the owners, kept inside a stadium the rest of us are not allowed to enter, which leaves one uncomfortable question hanging in the air. If the machine only ever pays its owners, and ownership is already this concentrated, what happens to a country where fewer and fewer people own the one thing everyone's future depends on? Here is where this all finally lands. You do not need to beat the market, and you will never have to outtrade a hedge fund, call the next crash, or pluck a single winner out of that brutal 96%. What you need is one thing, and it is smaller and more radical than any of that. You have to stop being only a worker standing inside the machine and become, even a little, an owner of it. Because the line that has separated the wealthy from everyone else was never how early you woke up or how hard you worked. It is whether you own a piece of the work that everyone else is busy doing. That is the secret, and it has been sitting in plain sight your entire life. But owning a slice is only the first door. Because the machine has a second, quieter mechanism, one almost no one watches, that decides whether the dollars your ownership earns hold their value in your hands, or slowly melt while the number on the screen keeps ticking upward and fooling you into feeling rich. That mechanism is already working on the money in your account tonight, so follow along before it costs you, because once you see how the second machine runs, you will never see a rising number the same way again.